Stop-loss orders are a critical risk management tool in trading and investing. They help limit potential losses on a trade by automatically selling an asset when it reaches a specified price. Ignoring stop-loss orders can expose traders and investors to significant financial risks. Without stop-loss orders, losses can accumulate rapidly, especially in volatile markets. Using stop-loss orders helps protect capital and prevent emotional decision-making. Therefore, understanding and implementing stop-loss orders is essential for effective risk management. A single bad trade can initiate a cascade of negative consequences. Emotions often cloud judgment, leading to irrational decisions in subsequent trades. Instead of cutting losses, traders may double down, hoping to quickly recover the initial loss. This behavior increases risk exposure and the potential for even greater losses. A manageable setback can quickly transform into a significant financial crisis. Disciplined risk management and rational decision-making are crucial to avoid this emotional trap. Hope, denial, and pride can significantly impact trading decisions. Hope can lead to holding on to losing positions, anticipating a turnaround that may not occur. Denial prevents traders from acknowledging losses, delaying necessary actions like cutting losses. Pride can hinder objective assessment, causing traders to stubbornly maintain losing positions to avoid admitting mistakes. Market irrationality can persist for extended periods, defying logical analysis. A trader's financial resources are finite, limiting their ability to withstand prolonged market anomalies. Hope is not a sound basis for trading decisions. It lacks a rational, analytical foundation. Relying on hope as a trading strategy can lead to insolvency when markets remain irrational. Loss aversion is a cognitive bias where the pain of losing is psychologically more potent than the pleasure of gaining. This bias significantly influences decision-making processes in various contexts. Individuals tend to avoid potential losses more than they seek equivalent gains. In financial markets, loss aversion can lead to suboptimal investment strategies. Investors may hold on to losing stocks for too long while selling winning stocks prematurely, driven by the fear of loss. Admitting being wrong in a trade is often emotionally challenging due to ego. A stop-loss order automates the admission of a trade error. It predefines the point at which a loss is accepted, removing emotional bias. This automation prevents holding on to losing trades in hopes of a turnaround. Stop-loss orders enforce discipline and protect capital by limiting potential losses. Recovering from financial losses presents a mathematical challenge. A 10% loss necessitates more than a 10% gain to return to the initial value. Specifically, a 10% loss requires an 11.11% gain to break even. This asymmetry highlights the difficulty in recouping losses compared to the initial gains. A recovery chart illustrates the challenges of regaining lost capital. It demonstrates that losses require a proportionally larger gain to recover. For example, a 25% loss necessitates a 33% gain to return to the starting capital. This asymmetry highlights the increasing difficulty of recovering from progressively larger losses. The percentage gain needed for recovery increases exponentially as the initial loss grows. Large losses have a severe impact on recovery potential. A 50% loss necessitates a 100% gain simply to return to the initial investment level. This illustrates a disproportionate relationship between losses and the gains required for recovery. The percentage gain needed to recover increases exponentially as the initial loss grows. Therefore, protecting capital and avoiding significant losses is crucial for long-term investment success. Consistent gains over weeks can be erased in a single trading session. Over-leveraging increases potential profits, but also magnifies potential losses. A stop-loss order is a crucial risk management tool. Without a stop-loss, losses can escalate rapidly and uncontrollably. A stop-loss order is a crucial tool for managing risk in trading. It functions as a form of insurance against significant financial losses. This order is designed to limit potential losses on a trade. It automatically triggers the sale of an asset when it reaches a specified price. Setting a stop loss helps traders avoid catastrophic losses. It provides a safety net in volatile market conditions. Defining risk tolerance is crucial before initiating any trade. Risk tolerance determines the amount of capital a trader is willing to risk on a single trade. A common rule suggests risking only 1 to 2% of total trading capital per trade. This conservative approach helps protect against significant losses and preserve capital. A stop-loss order is designed to limit potential losses on a trade. It automatically closes a position when the price reaches a specified level. The stop-loss level is determined by the acceptable risk, typically 1 to 2% of trading capital. Position size is calculated based on the distance between the entry price and the stop-loss price. Smaller distances allow for larger position sizes, and vice versa. This ensures that the potential loss remains within the predetermined risk tolerance. Consider an account with a total capital of $10,000. A 1% risk tolerance on this account equates to a maximum risk of $100 per trade. Assume a stock is purchased at $50 per share. A stop-loss order is placed at $48, limiting the risk to $2 per share. Therefore, the appropriate position size is 50 shares, $100 risk, $2 risk per share. Stop-loss orders are designed to limit potential losses on a trade. There are two primary types of stop-loss strategies: hard stops and mental stops. A hard stop-loss is an actual order placed with a broker to automatically sell a security if it reaches a specified price. Once the price is hit, the order is triggered, regardless of market conditions. A mental stop is a price level at which a trader decides to exit a position, but no order is placed. The trader must manually execute the order if the price reaches their predetermined level. A hard stop-loss order is designed to automatically limit potential losses on a trade. It ensures a trade is exited precisely at a predetermined price level. This type of order guarantees execution at the specified price, regardless of market volatility. The reliability and automation of hard stop-loss orders help manage risk effectively. Mental stops are control mechanisms that rely on human judgment and memory. These stops are susceptible to errors due to cognitive biases and lapses in attention. Emotional states can significantly impair the reliability of mental stops. Stress, fatigue, or personal feelings can compromise decision-making in critical situations. Therefore, mental stops are generally considered less dependable than automated or physical safeguards. Stop-loss orders are essential tools for managing risk in trading. Effective stop-loss placement should be based on market structure, not arbitrary percentages. Market structure includes key levels, such as support and resistance. Support levels can act as a floor, preventing further price declines. Moving averages can also indicate potential areas of support or resistance. Using these levels helps ensure stop losses are logically positioned relative to market dynamics. Placing a stop-loss order is a risk management technique used in trading. A stop-loss is placed below a logical support level. This placement allows the trade some room to fluctuate naturally. It also defines a clear point where the trade idea is considered invalid. Employing a stop-loss is a risk management technique, not a predictor of trade success. The primary goal of using stop-loss orders is to protect capital. It ensures traders can withstand inevitable market fluctuations and losing trades. This approach is vital for long-term survival and consistent participation in the market. A stop-loss order functions similarly to an insurance premium in trading. The primary goal is to safeguard trading capital. It protects against the risk of a single, catastrophic trade. Without a stop-loss, a large loss can significantly deplete available funds. By setting a stop-loss, traders limit potential losses on any given trade. This helps maintain capital and enables continued participation in the market. Professional traders emphasize loss control as a primary objective. They prioritize minimizing potential downsides over striving for constant accuracy. A key strategy involves allowing profitable trades to continue and expand. This means letting winners run to maximize potential gains. Conversely, unprofitable trades are quickly terminated to limit losses. This practice of cutting losers is crucial for preserving capital. The market operates independently of individual perspectives. Individual analyses do not influence overall market behavior. Hopes and expectations of individuals are irrelevant to market dynamics. Profit and loss statements of single entities do not sway the market. Objective risk management is crucial due to the market's impartiality. Market indifference necessitates data-driven decision-making. A stop-loss order is a tool used to limit potential losses on a trade. It acknowledges the inherent unpredictability of the market. It serves as a proactive risk management strategy. By setting a stop-loss, traders aim to mitigate downside risk. Disciplined use of stop-loss orders is a critical element for successful trading. Stop-loss orders serve as a protective measure for trading capital. These orders automatically limit potential losses on a trade. By mitigating risk, stop-loss orders help preserve funds. Protecting capital is essential for long-term market participation. Consistent use of stop-loss orders supports sustainable trading practices.